This video is an uncovered Japan company research report on Enshu Truck, ticker 9057. It is a Japanese regional logistics operator with an in-house fleet and an early relay line haul network, supported by a strong balance sheet and a roughly 3% dividend yield. The central question is whether it can translate industry capacity tightness into durable margin recovery. At the research date, Enshu Truck traded at about 10.6 times trailing earnings and 0.96 times book value, with a 3.01% dividend yield. Its equity ratio was 62.2%. Those figures provide asset and income support, but they do not solve the underlying operating issue. Revenue has grown, while profitability has not kept pace. Enshu Truck does more than point-to-point trucking. It operates general cargo transport, freight forwarding, warehousing, and procurement logistics, including kitting and supply chain work near manufacturers. It also runs joint distribution for products such as chemicals and food. The key difference is that it keeps its fleet, drivers, and dock workers in-house, giving it direct control over capacity, quality, and service reliability. From fiscal 2022 to fiscal 2026, revenue rose from 42.75 billion yen to 49.95 billion yen, a 5-year compound rate of 4%. Operating profit, however, moved from 3.22 billion yen to 3.11 billion yen. The operating margin fell from 7.5% to 6.2%, as wage and fuel costs outran price pass-through. Operating profit and net income have both stalled, while revenue has risen. Fiscal 26 operating profit was 3.11 billion yen, and net income was 2.26 billion yen. The report's diagnosis is therefore operational rather than accounting-related. Cost inflation and incomplete price pass-through have limited profit conversion. Logistics remains 99.7% of sales, so improving its economics is what will determine consolidated profitability. The Moat is relay line haul, which Enshu Truck calls e-change. Instead of one driver running a long route and facing an overnight stay, drivers exchange trailers at a midpoint hub and return home the same day. This matters after Japan's April 2024 overtime cap for truck drivers. The company built the network before the rule change, helping it secure long-haul capacity, support driver retention, and serve customers reliably in a tightening market. Cash flow is a material offset to the weaker profit trajectory. Fiscal 25 operating cash flow reached 4.83 billion yen, and free cash flow reached 4.1 billion yen. After the earlier investment cycle had pushed free cash flow negative in fiscal 24. That recovery adds flexibility. But the report cautions that investors should distinguish the end of heavy investment from a permanently higher cash flow run rate. Enshu Truck's balance sheet is a genuine strength. The equity ratio rose back to 62.2%, cash stood at 7.4 billion yen, and the investment cycle has eased. The mirror image is return on equity. It declined from 12.6% in fiscal 22 to 9.1% in fiscal 26. Any stronger re-rating will likely require better operating returns as well as balance sheet resilience. The strategic path is coherent. Procurement logistics can make customer relationships stickier, while e-commerce delivery and joint distribution offer growth channels. Yet the risks are specific. Amazon Japan and U-Co-op are important customers, creating concentration, and Enshu Truck has not consistently passed wage and fuel inflation into freight rates. The company can grow volume. Its next proof point is converting that growth into margin. The report places the current price-to-earnings ratio around 10.6 times, a little above the roughly 9.2 times average since fiscal 2020. On earnings alone, the shares look fairly valued, rather than deeply discounted. The more supportive valuation signals are the sub-book price-to-book ratio and the dividend yield. A meaningfully higher multiple would need evidence of margin recovery and better capital returns. The research presents illustrative scenarios, not forecasts or recommendations. By fiscal 2029, its bear case produces an implied 2,080 yen share price. The base case, 3,300 yen, and the bull case, 4,800 yen. The difference is mostly operating margin and the valuation multiple. The practical indicators to watch are freight rate pass-through, customer diversification, free cash flow, and capital return decisions. Enshu Truck combines a physical relay logistics advantage, an in-house operating model, solid cash resources, and a shareholder yield near 3%. Against that are persistent margin pressure, customer concentration, a thin float, and a 60.6% parent stake. This is not a recommendation. It is a focused research watchlist. Pricing power, operating margin, capital allocation, and governance will determine whether the balance sheet support turns into a durable re-rating. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.